When you boil it down, insurance is really just a promise. If something bad happens, we've got you covered. But to make sure that promise is actually worth something, there's a whole mountain of rules working behind the scenes. Today, we're going to crack open the official rule book for Pakistan's insurance industry, the Insurance Ordinance of 2000. So let's peel back the curtain and see what it really takes to back up that promise. So, how about we tackle this by actually following the entire journey of an insurer? I mean, from the very first spark of an idea, through this incredibly complex legal maze, all the way to becoming a real operational company that people can actually trust. This is basically your step-by-step guide to how it's all built and regulated under Pakistani law. Okay, so here's our roadmap. We're starting with the absolute foundation, the insurance contract itself. Then we'll look at the two big paths an insurer can go down. After that, we'll dive into what it takes to get the official green light, explore the financial rules that keep these companies from collapsing, and finally, see how they're constantly kept in check. All right, let's start at square one. Before you can even think about building an insurance company, you have to get your head around the one thing you're actually selling. And the law is very, very specific about what that is. So what does the law say? Well, think of it like this. It's a trade. You give the insurer a small, regular payment, that's the premium, and in return, they take on a huge what if for you. What if there's a flood? What if there's a car crash? That if is the key part, and this contract is the safety net that's supposed to be there to catch you. Okay, so you get the basic idea of the contract. Now comes a massive choice. Seriously, the law makes you pick a path right at the very beginning. It splits the whole industry into two totally separate worlds, and every insurer has to choose a side. So on one hand, you've got life insurance. This is all about the human lifespan, right? It covers things like death, it can provide income when you retire, or handle your medical bills. And on the other hand, you have non-life, which is, well, it's pretty much everything else. This is the insurance for your car, your house, your business, all the stuff you own and the liabilities you might face, usually on a short-term, yearly basis. And if you zoom in on life insurance, the ordinance gets really specific. It's not just one thing. It covers your standard life policies, the ones that protect a family, but it also includes investment-type products, the pension funds that are so important for retirement. And it even has a whole separate category just for accident and health coverage. Now, with non-life, wow. What's crazy is just how much this stuff is woven into, well, everything. We're not just talking about your personal car insurance here. This is the backbone of the entire economy. We're talking about insuring giant cargo ships, protecting farmers from a failed harvest, and shielding businesses from lawsuits. It's a huge, essential ecosystem. All right, so you've picked your side, life or non-life. Now for the really tough part, getting official permission to actually start selling insurance. And this is where the big boss of regulation steps into the picture. Every single company that wants to be an insurer has to get past the Securities and Exchange Commission of Pakistan, the SCCP. These guys, they are the ultimate gatekeepers. Their whole job is to make sure that only serious, stable, and well-funded companies are allowed to make those promises to the public. And let me tell you, this process is meant to be a hurdle, and for good reason. You have to be a public company, for one, which means more transparency. You have to hand over a literal mountain of paperwork, including a 10-year business plan. An actuary has to sign off on your math. The SECP goes through every single detail with a fine-toothed comb to weed out anyone who isn't completely prepared. And if you need any more proof that this is serious business, look at this number. A foreign company wants to get into the Pakistani market, they need to show up with at least $4 million US. This is not a game for small-time operators. It's a super high barrier to entry that's designed to make sure companies are stable from day one. Okay, getting registered, that's just the starting line. Now we get to the absolute most critical part of running an insurance company, proving every single day that you have enough cash to pay every single claim you might owe. This is what we call solvency. Look, this isn't just a friendly suggestion. It's the absolute bedrock of the entire system. All of these rules, all this regulation, it's all designed to make sure insurers stay solvent. Because think about it. If they can't pay their claims, that original promise is broken, and people who counted on that protection are left with nothing. So for the non-life guys, the solvency test is kind of like a triple threat stress test. They have to figure out their financial cushion based on a minimum amount, based on how much money they're bringing in, and based on what they might have to pay out. And here's the key. They have to hold the highest of those three numbers in reserve. It's a triple check to make sure they're ready for anything.
Life insurers, they get their own specific benchmark, a really clear line in the sand. Inside their shareholders fund, which is separate from policyholder money, they have to keep a surplus of at least 75 million rupees. It's a crucial safety buffer for the business.
And on top of all that, you've got these massive requirements for paid-up capital. But here's the real kicker. The law says this capital has to be net of accumulated losses. What does that mean? It means if the company loses money, it has to put more cash in to stay above that 500 or 700 million rupee line. It's not a one-time thing. It's a constant pressure to prove you're financially healthy. So, the company's finally up and running. It's solvent. Great. But how does the SECP know it's staying that way? Well, the answer is a constant, never-ending cycle of reporting and auditing. This is definitely not a set-it-and-forget-it kind of business. The oversight here is, well, it's relentless. It never stops. Every 3 months, these companies have to file detailed reports. And at the end of every year, they have to submit a full, comprehensive, audited financial statement. This constant stream of data lets regulators catch problems way before they blow up. And it's not like the company can just turn in its own homework and call it a day. Oh no. An independent auditor, who has to be approved by the SECP, comes in to check everything. They're that crucial, unbiased second pair of eyes, making sure the numbers are real and that the company is playing by every single rule in the book. You know, after all the complex rules and all the huge numbers, it really boils down to this one single idea right from the ordinance itself. Every single thing we've talked about, registration, solvency, reporting, it all serves one ultimate purpose: protecting the interests of the person who bought the policy. That is the absolute mission. So when you step back, you see this whole system is designed for one thing: stability. These rules are like high walls built to keep policyholders safe. But high walls can also keep new people out, right? And that leaves us with this really tough, fundamental question of regulation. How do you build a system that protects people without killing the competition and new ideas that could actually make things better for them? It's a balancing act, and it's something regulators have to think about every single day.